Good morning, everyone, and thank you for joining the Zoom Rail Energy Transportation Advisory Committee meeting. I'm Kristen Nunley. I am the designated federal official for RETAC, the DFO. We're going to start with just some remarks, some announcements here. We are using the Zoom platform. If you are joining us as a panelist, please mute your microphone and video unless you are presenting. Questions can be asked either verbally, or we do have a chat function that you are welcome to use. Your icons are visible. If you move your mouse, there will be a toolbar that appears at the bottom, or you can click on your name or hover over your name and 3 dots will appear at the top right of your screen, and you can use that as well to navigate your views. I will now turn the meeting over to our RETAC co-chairs, George Dugan and Brian Fuller.
Hey, good morning. This is Brian Fuller. I believe I'm going to do the opening this morning. Welcome to our virtual meeting, a little bit different than the last time that we met 11 months ago in Paducah, Kentucky. A few things have changed since then. Let me begin with a quick safety moment. You know, we're in a kind of a weather transition period right now. We're into October. We've actually had some cool weather in certain parts of the country. We've even had a few snowstorms out west and things of that nature. My message to you is be mindful of what's going on. Things can kind of ebb and flow pretty quickly. Down here in the Southeast, we are, you know, we've had some cool weather. It's going to get hot again today. And oh, by the way, we've got another hurricane that's brewing out in the Gulf that's going to be coming our way by this weekend. Every area are seeing kind of these ebbs and flows right now, and be careful and be mindful of what's going on with the weather, with road conditions, things of that nature. So just make sure that you don't let your guard down during this kind of fall transition period. As far as just kind of what's going on, like I said, you know, we've been, it was 11 months ago, we were in Paducah and we met in person, had a great in-person meeting. Since then, a few things have transpired, maybe, since March. We've had businesses, we've had schools, we've had some industries that have either shut down, they've paused, they've been up, they've been down, and things of that nature. What hasn't stopped, though, is our industries that are represented on this call today. And what hasn't stopped is rail commerce and the importance of it. And so it's good to be back together. Looking forward to some really good updates across the various sectors. And with that, we're going to start with our oil update with Lee Johnson. And I know it's still dark out there, Lee, but I'm going to turn it over to you to begin the industry segment updates.
Thank you, Brian. Can everyone hear me?
Yes.
Wanted to, as a bit of an introduction, let you know that we've taken a very different approach on the oil segment update this time around. Historically, we have tried to look at trends, history, what's going on, and see how things grow and shrink and what happens. This time we have done 2 things. One is we've focused just on what has happened since the Paducah meeting. So that was based on August of 19 data. And what we've done is looked at what's happened between then, and we have some June, some July, some August data on the slides. The other thing we've done is we've gone to primarily single topic slides, tried to get some of the complexity out of some of the old slides we had, just so it's a little easier to follow on the small screen. So hopefully this will all make sense. And Kristen, if you could go back to slide 1, that'd be great. Perfect. Oh, next slide, please. Starting at the global level, we can see in the top slide from EIA that production and consumption went along at a fairly compatible pace until the first of the year. And that's when the Saudis and Russians decided they were going to try and flood the market with oil and get market share right at the time when, because of the virus, things were cratering. So you can see the dip in the consumption line went down much more dramatically than the dip in production, resulting in surplus and global surplus and a lot of need for finding storage as capacity filled up and demand went down. Eventually, the production did catch up as far as the decline was concerned, but the inventory was significant. And the bottom little box there is way too small to see, but I just find it interesting that it shows the day that WTI went negative, and it was just there for a day. But since then, pricing on WTI and Brent have been bouncing vigorously along, very volatile situation, and that continues, running in a range of 35 to 45 dollars per barrel. Next slide, please. This is what's happened with the U.S. Crude oil production. Peaked in November and bottomed out in May, a decrease of a little over 20%. Has recovered a little bit. It's up to 10.8 in August, and that's about 6% recovery. The production in the lower 48, which is the land-based unconventional production, peaked at almost 11 million barrels a day in November and went down to 8 million in May, a decrease of about 26%. It has had some recovery since then. It's now up to almost 9 million barrels a day. About 12 million have come back. The production in the Gulf has slumped somewhat. That's hasn't recovered primarily because of all the hurricanes that have come through. Each time we have a hurricane, it shuts down the Gulf production 7 to 10 days per platform, and that's the reason that that hasn't recovered at all. And the Alaska production has been flat for some time. Next slide, please. The rig count has, of course, decreased dramatically, and the rig count is total. So this is gas and oil, land-based. To give you a feel for what we had back in August with the 904, that was 546 rigs in North Dakota and Texas, Oklahoma, and New Mexico. So it's about 60% of that. The balance would be gas and other oil-producing rigs. That went down to 265 by June. That's only 11 rigs in North Dakota and 177 in Texas, Oklahoma, and New Mexico. So it's down about 75%. And the production has continued to grow, even though the rig count is down, because the concentration is on completing previously drilled wells. So the production operations are continuing, but the exploration portion has been greatly reduced. Next slide, please. There we go. This is often just kind of referred to as, back one, please. There we go. This is commonly referred to as the Permian, but actually it's 3 different basins in Oklahoma, South Texas, and West Texas, the Anadarko, Eagle Ford, and Permian. And the production there went down dramatically with the virus, 27% by April, doing a little bit of recovering. Texas took the biggest portion of that reduction. They went down almost 29%. New Mexico came down about 20%, and Oklahoma about 40%. But the biggest volume portion of that reduction was in Texas and the Eagle Ford and Permian portions. Next slide, please. The group has always been rather interested in the differences in crude by rail in what's happening in the Southwest and what happens in the Williston Basin. So we keep track of the volumes that do ship by rail within the Pad 3 with the Southwest and between Pad 3 and the West Coast. This is in thousands of barrels per day. So it's quite a small volume. The peak was at about 46,000 barrels a day, which is roughly equivalent to 70 cars a day. And with a reduction of 87%, it's down now where the combined to within Pad 3 and going from Pad 3 to West Coast is down to about 9 carloads a day. So export by rail in that region remains a very small portion of the overall export. Next slide, please. Williston Basin also took a big hit. Reduction went down 43%. It is recovering and is about 1.1 million barrels a day for August. The biggest, I should mention that the next portions of the slide are the share of that production and how they move, the modal moves. And the pipelines took the biggest hit when the production went down, the initial hit, about 47% reduction. That has bounced back with the growth in production. Rail took a slower downturn, but is down about 50% and is running fairly flat now. The local refined and truck and rail between the Williston and Canada remains a fairly small portion of the business. Next slide, please. Thought this was a fairly interesting piece of information that came from the North Dakota Pipeline Authority. And it's month by month showing how many wells were active and how many were shut in. And you can see that there were almost 7,000 wells shut in May, decreased to a little over 5,000 in June, and down to a little under 4,000 by July. So this correlates with the increase in production we've seen, but it's more a factor, once again, of production and not of exploration. Next slide, please. This slide is the total US and Canadian crude by rail. And I need to point out that the Canadian portion here is only the movements between Canada and the United States. So the movements within Canada are not included in this. And the peak back in January was about 1,200 cars a day. And that has been reduced to where the total is now about 270 cars a day, 78% reduction. Next slide, please. And we've always focused a little bit on where the Canadian oil is going, and that has always been predominantly to the Gulf, where there are better markets for the tar sands oil, but that is down dramatically to where, it started out at about 600 carloads a day, and it's down now to about 65. And the last slide. And I'm sorry, this is the only one that's kind of an eye chart. Just summarizing what we've gone through, the production consumption fell much faster than production, leading to surpluses. The prices of WTI and Brent are still very volatile. Yesterday WTI closed at about $38 and Brent at about 40, but they're moving within a fairly narrow range, but much more dramatically than we would normally see. U.S. production was down substantially, mostly based on land-based production, and we continue to focus on completions instead of exploration. Similar story for the Southwest, and of course, Southwest CBR is a minor portion of the export of their substantial production. Likewise, Williston Basin had a dramatic fall. The well shut-ins have improved between May and June, and that seems to be continuing. Total crude by rail U.S. and between U.S. and Canada is down 78% between January and June. And the Canada to the Gulf is down substantially. The two items on the bottom, the last two, I think are one's an update and one is new. PHMSA did rule in May that the federal law preempts Washington State's law. If you'll recall, Washington State passed legislation limiting the vapor pressure for Bakken crude to a limit, and the DO that was challenged by the states of North Dakota and Montana. DOT had a study done by Sandia Labs where they compared the physical characteristics of Bakken crude, Texas crude, and samples from the strategic oil reserve. And Sandia's findings were that there were basically no material differences between the three of those and their volatility, and that vapor pressure really had little to do with any of this. Based on the Sandia report, and the DOT did rule that federal law preempts the state law, and that legislation is no longer impacting the business. The item that remains open and is quite of a concern is the Dakota Access Pipeline. And back in July, DC federal judge ordered that the pipeline be shut down and emptied by August 5th. The reason being that the judge thought that the claims from some of the tribes about the environmental impact studies that were done prior to the pipeline being built and going into operation 3 years ago weren't adequate. There were rapid appeals of that, and the district court, appeals court, overturned that decision or stayed that decision, and pipeline continues to operate, but there is continuing environmental study going on, and we don't really know how that is going to impact the overall situation for export in the Bakken. There is approximately 1.3 million barrels a day of pipeline capacity coming out of the Bakken. And DAPL is 600,000 of that. So this can have a significant impact on the export and could potentially put some pressure on more export by rail. However, the markets are different, and the Dakota Access Pipeline goes to Patoka, Illinois, which is not rail served last time I looked, and then connects to another line that goes that serves Nederland, Texas. So there's not a lot of rail market between those points. So that's all I have, unless there's any questions.
I think Brad Hildebrand raised his hand.
Great. Thanks, Lee. That was great. 2 quick questions for you. How easy is it to bring up a well once it's shut in? And then secondly, can you give us a little bit of a flavor for what's going on with OPEC, Russia, and kind of the world markets as well, please?
I wish I could, Brad, but I've got to admit I haven't looked into the specifics of the operation as far as bringing back shut-in wells. So I really can't talk about that. And I haven't concentrated on what's going on with the global markets. Good questions, though.
Any other questions for Lee? Okay, well, thank you for that update, Lee. A few things have changed pretty dramatically, it seems. So
Indeed.
Appreciate the update. All right, next on the agenda is going to be rail cars, and that's going to be Bob Hewlett. So Bob, I will turn it over to you.
Thank you, Brian. Good morning, everyone. Appreciate the opportunity to present this morning. As has been done in the past, the 2 railcar owner members of RETAC have coordinated the presentation, that being the Greenbrier companies as well as Trinity Rail. Kristen, you want to move to the first slide? As you can see, basically, we've seen a significant decline in the demand for new rail cars. This has been due to changes in the energy market, a lot of what Lee has just informed us about, as well as some of the impact of COVID-19 on the economy in general. The top part of the slide indicates rail car or freight car activity, non-tank car activity. The lower segment of the slide is tank car activity. And the solid line in both cases shows the backlog of rail cars in either of those categories. I think interesting to note, you can see a rapid decline in the orders, and in essence, throughout 19, we saw production exceeding orders, which is results in this significant decline in the backlog. So obviously a significant softening in the demand for new rail cars. Next slide. Looking forward, we expect that it's going to continue to contract as far as demand into 2021 with a recovery in 2022, but certainly not coming back to the levels that we saw just prior to this particular year. Again, uncertainty is driving that. What we are seeing is there will be some demand for tank cars, but that tank car demand will not be from energy-related movements. We see some improving demand in grain cars and as well as hopper cars for plastics. And has been the case, intermodal tends to be a steadying influence on the demand as we move through these years. Next slide, please. Coal. When we first started with RETAC back in the beginning, coal was a primary focus, and was an interesting story what's happened in the coal markets. Coal loads are down 27.2% year to date compared to last year. And we have a significant number of cars in storage, 30% of the gondolas and 34% of the hoppers. We're going to continue to see attrition in this fleet as we move forward because the supply of cars still significantly exceeds what the demand is. And noting that in the remaining fleet is nearly 200,000 cars, there's 35,000 of those that are over 35 years of age. Next slide, please. When we look at the cars in storage, we see a significant increase driven by that drop in the demand for transportation by rail. And based on the fact that we have excess cars, we really don't see any new demand for coal cars in the near future. And as I mentioned, the current fleet size is 96,000 hopper cars and 102,000 gondola cars. Next slide, please. Similar, energy cars returning to storage. The top graph relates to the small cube covered hopper cars, which were cars that transported the sand for the fracking operations. And we've seen a significant decline over the last several years in demand for those cars, and that demand continues to go south. So we see a dramatic increase in the storage of covered hopper cars to the extent that we're trying to look for ways to redeploy those cars into other services by making them a different size hopper car. Tank car storage is on an increase, which tracks a lot of what Lee had just said, and obviously reduced car loads in crude oil, ethanol, and refined products are all impacting that market. Next slide. We started to talk about LNG over the last couple of meetings. Obviously, there's been increased interest in LNG based on changes in the energy market. Look here, between 2010 and 2018, I think it's interesting to see that the number of facilities increased by 28.7%, and storage and vaporization capacity increased 21 and 23%. Total liquefaction capacity increased by 939% due to new LNG export terminals. There has been a final rule issued by PHMSA allowing the transport of LNG and DOT 113 tank cars. Significant difference in these tank cars versus earlier versions of 113 is that this is a tank in a tank design, so the commodity is encased in a tank that is then protected by an outer tank. And the thickness of that outer tank is now going to be 9/16 inch and made from TC128 grade steel, which has been the go-to steel in the tank car market for a number of years. So with enhanced liquefaction capacity and lack of pipelines, there could be growth in the LNG by rail. There's still some hurdles. There have been some work stoppages on some of the facilities. So the growth of the market is still a bit uncertain, but the potential exists. Next slide, please. We've been tracking recently over the last several meetings the fleet size in response to the market, and more importantly, the composition of the fleet size. I think you all recall that we've gone through a significant reconfiguration of the fleets in Class 3 flammable liquid services, moving toward compliance with the FAST Act and introducing DOT 117 tank cars as compared to DOT 111 tank cars. The line graph shows the active fleet in service of crude oil, and you can see from the boom days in the 14-15 time frame, the decline, a little bit of recovery, and then up into 19, and then more recently the decline based on current conditions. The bar chart shows you the composition of the fleet, and I'll take you to the far bar just to show you that 81% of the fleet is now DOT 117 compliant, which has been a significant achievement over the last number of years. Next slide, please. Similar comparison on tank cars in the ethanol market. A little less volatile than perhaps the crude oil market, but still showing some decline in recent months, actually recent years. And I'm sure Brad or Mark will be talking about that in a little more detail. The compliance dates for the tank cars and ethanol were pushed out a little further than those for crude oil, but we still are making great progress there as well. If you look to the furthest bar, we're 68% are DOT 117 compliant as of the second quarter of this year. Next slide, please. And the remaining flammable liquids seen some increase, again, significant fleet size and some increase over with refined products and other activity here through 19, which has been declining based on overall economic conditions. This fleet compliance dates are pushed out based on the volatility of these products to 2025 and to as far as out into 2029. So you see in the furthest bar that just 24% of that fleet has been converted to the 117 configuration. Next slide, please. Part of this has been achieving the growth in 117 has been due to introduction of new tank cars. And this is a graphic that shows you that 41,521 of those tank cars have been introduced into the fleet since the inception of that regulation and the introduction of that car type back in 14. The next slide shows that there's been a significant level of activity in the modification of existing DOT 111 or CPC 1232 tank cars into a 117 configuration with just over 32,300 cars modified in the same time frame. Again, significant activity on the part of the industry to respond to the need for those 117 tank cars. Next slide, please. The next question obviously is, well, are we going to be able to meet the compliance dates? And the answer to that is yes. Right now, the remaining fleet sizes to be converted or replaced in ethanol is a sum of 9,635 111 tank cars and 1,062 CPC 1232 tank cars. You may recall that the CPC 1232 was an industry standard that was introduced prior to the final regulations and the changes, which provided some improvement over the 111, but not to the extent that the 117 provided. Those cars will need to be either modified or replaced similar to the 111s. In crude oil, ethanol, jacketed CPC 1232s requiring replacement by 2025, numbers 4,800. And then in the other flammable liquids, as I mentioned, with a compliance date of 2029, there's a significant number, over 37,000 cars. So a total 52,890 tank cars would need to be retrofitted or replaced based on current market demand. The next slide will show you the fact that we need between 492 to 678 cars per month to meet the various deadlines. The new production over the last 3 months of 117s has averaged 625 a month, and the modification 762 a month. So that particular rate of production or modification far exceeds the necessary demand to meet the compliance dates in the out years. So we're confident that we'll continue to be in a position to meet those deadlines and are actually in some degree ahead of the marks based on our progress. And that completes my report for this morning.
Any questions for Bob?
I guess one last comment, anybody that needs rail cars, we have plenty available.
Bob, this is Ann. I do have a question for you.
Yes.
With respect to the slide on the coal cars and the number that are in storage, you also commented that there was sort of an effort or looking at possibly, I don't think you used this word, but repurposing some of the cars, and you mentioned sort of resizing them. Could you talk a bit more about that? Like, you know, what percentage of some of the cars in storage might actually have future value in a different form?
Sure, and it was actually the sand cars, not the coal cars.
Well, actually, are the coal cars that are in storage, can they be repurposed to something different?
Not nearly as easily as you know, a steel structured car. They're aluminum structured cars, and they're single use, solely configured for the coal market. What we're looking at doing, referencing the hopper cars, is that many of those cars are relatively young. So what we're looking at is what would typically be called a rebodiing, and putting a different type of hopper car and utilizing the running gear from those cars. We don't have the same flexibility in the coal market because the cars are older, so the componentry is older, so it's not as attractive to try and repurpose those cars. And it would mean a totally different car type.
Thank you.
And I forgot to mention Jim Rader's on the call. And Jim, I should have given you an opportunity to comment if you had anything to add.
I have nothing to add, Bob. It's a good report. Thank you.
Hey, Bob, it's Brad.
Yes, Brad.
What is the difference between a DOT 120J and a 117J, please?
There was a small number of cars built to the 120 specification. They are a slightly thicker head dimension, and the fittings, the top fittings arrangement is a little different on the cars. They're essentially comparable to 117, but there were, I think, in excess, maybe a little over 300 cars built to that configuration that were introduced into Class 3 flammable liquid service.
Okay, thank you.
Little techie, sorry about the answer.
No, I just hadn't seen that designation, and I was curious what the heck those were. Now I know. Thanks.
Any other questions for Bob? Okay, well, thank you very much. Next on the agenda is going to be ethanol and biofuels, and I believe that's going to be Mark Houston. So Mark, I'll turn it over to you.
Thank you. I want to make sure everybody can hear me. Am I coming through okay?
I can hear you.
Okay, good. Good morning, everyone. Thanks for having us in today. If you want to go to the next slide, Kristen. My name's Mark Houston. I'm with Lewis Dreyfus Company here in Kansas City, and I have two really good partners on the biofuels team, Brad Hildebrandt from Cargill, Minneapolis, and Jeff Ellison from CHS, Cenex Harvest States in Minneapolis also, and they contributed to this presentation greatly. So thank you guys. And they'll take all the tough questions, I might add. Let's start with corn production. That's the base, obviously, of most of the production of ethanol in the U.S. And this is a quick map of where our production by state-wise going into the fall harvest, which we're into the heart of right now. As you can see in the green states, we've had an increase in production, significant, I might add, in the east. And the red states are slight declines in a few of the states in the west. Overall, we have a very, very good crop year coming in. The 2021 crop year, as we call it, starts September the 1st and runs through August 31. The overall look at it is about 1.3 billion bushels of additional corn this year from last year. Next slide, please. What we see is we had 2 million more acres of corn planted, and that's the result of we had some preventive planting in 2019 in certain areas, some of the areas in the east and in South Dakota in particular. So it leaves us with about 2 million acres of additional harvest. We've had very favorable weather for most of the year. We've got a little dry in the west at the tail end of the crop, but we're looking at 11 bushels per acre additional production on corn this year. You carry that in with, you put that in with the carry in of 2.2, production at 14.9 billion. We've got 17.2 billion bushels of corn supply available for all uses, including ethanol. And a quick look there, what some of our disappearance on corn is on an annual base. We got feed and residual, food and industrial, which is mainly ethanol, and then exports. And exports this year are pretty strong. They're estimated to be pretty strong for this crop year. So we're going to disappear about 14.6 billion bushels of this 17.2 carry in and production that we have this fall. And that'll leave
Hey,
us
Mark.
with a, yeah.
Yeah, sorry. Go finish your thought, and I'll jump in. Go ahead.
But I just say that'll leave us with 2.5 billion bushels of carryout, which is a nice buffer to have going forward, and it helps in price stability. Go ahead, Brad.
Yeah, thank you. Sorry to jump on top of you there. Couple things just for people's information, that 14.9 billion would make this the second largest corn crop on record. So we got a big corn crop coming at us. As Mark mentioned, it's dry, and this corn and this harvest is moving along fairly rapidly, particularly right now in beans. We're ahead of pace relative to normal. The other thing to mention about just the worldwide supply and demand is that Ukraine and Russia, who compete certainly with the U.S. for corn exports, had a poor year. They were dry, and so their production is down. So the U.S. is really in the driver's seat this year as far as overall supply to the world market. Right now, we're watching dry conditions down in South America as well. So, again, all of which points to a very good year for the U.S. Production and for exports out of the United States.
Thank you, Brad. Kristen, you want to go to the next slide? This is a chart put together by Pro Exporter, and it outlines ethanol production and dry corn milling margins. And you can see over the last number of years, we've progressed slightly on an uptrend in production. And then come March, we had just a devastating demand destruction on gasoline, and it related to the ethanol side of the production also. And we saw almost a 50% decline in ethanol production over a 60 to 90 day period of time as a result of demand destruction on the gasoline side. Margins went to negative numbers, minus 10, minus 20 cents a gallon before we started slowly rallying back. And we're currently at about 90% of where we were March 1 of 2020 on ethanol production, and gas consumption, I think, is mirroring about the same. Ethanol production obviously trails gas demand, so we're moving up. We still have 42 plants that are closed. We're running at about 75% of our rated capacity of 17 billion gallons. So we're currently at about 13.5 roughly billion gallons of production. So we devastated this industry. We've seen some fallout that may be permanent, unfortunately. Of the 42 plants, there's some significantly large plants in that number that are not operating today, and may be coming back on in the future here, but for the time being, they're still offline. As a result of reduced production and increasing demand, we've seen margins actually improve to levels that are somewhat supportive of 20, 25 cents, maybe in the spot, you get up to 35 cents. So from that standpoint, we're generating some positive returns on the production that we're running today. The RFA mandate in 2020 was 14 billion gallons, and they haven't set it yet for 15, but it looks to be, it could come in around 15 billion gallons on the mandate. So far this year, we're at about 860 million gallons of exports. We project that to go to 1.25 billion gallons, and that's down about 250 million gallons from 2019. We have no Chinese business in this in these exports yet. Next slide, please. This is a chart that Houston Biofuels puts together, and they watch in-transit inventories, train speeds, and dwell time, billing to pull times on unit trains. And the gray portion of the chart is the in-transit inventories. And as you can see, we're right around 1.2 billion gallons of in-transit inventories. The red line is train speed, and over the last 6 or 7 years, that's been fairly constant. Probably the best side of the cycle is around 25 miles per hour, and it dips down to maybe in the 20 or high teens at times. So very constant there. A few little blips in it, I think, can be explained by weather. And then, as I mentioned, we look at, or they look at the dwell time at origin from billing to departure. And we're running around 20 hours from billing release to actual departure of train. So it's running pretty good. These are not shuttle trains, obviously, so the power situation is operated a little different than the grain trains. So overall, doing pretty well in these categories. Next slide, please. We also take a look at biofuel production, and always a little lag here, about 3 months in reporting production from EIA sources. But as you can see, there's no demand or production destruction here that we saw over in the biofuel side of ethanol and or gasoline. And I guess that's probably reflects the essential nature of the trucking industry during the pandemic. We anticipate 2020 production to be about 2.25 billion gallons, up about 50 million gallons from last year. And as a side note here, the majority of this, 57 to 60% of biodiesel is made from some sort of soy oil-based product from either soybeans, possibly canola. Production on the biodiesel side looks good. Margins are a little bit depressed right now because of the price of the oil stocks to produce the biodiesel. But we still have, obviously, the blend credits that are out there through a couple more years. Next slide, please. And just in closing, a few highlights I'd like to hit here. Obviously, we talked about ethanol production dropping 50% during the pandemic, as did gas consumption. They kind of mirror each other. Ethanol exports, we anticipate 1.2 billion gallons. And again, that's without China importing anything at this point in time. China is still on the sidelines. Phase one requires them to buy $40 billion worth of agriculture-related products. And so far, none of that has been ethanol. Obviously, it's been big on the soybean side and a fair amount of corn. EPA has rejected 54 out of 68 small refinery exemptions that were in place over the last 3 or 4 years. The remaining 14 are under review. We don't know if that's going to create extra demand for actual physical blend, or if that demand will be satisfied through the RIN side of the business. Margins, as I mentioned, in ethanol has improved from negative levels during the pandemic, which is helping support the industry. Margins in biodiesel are suppressed a little bit due to feedstock pricing. No major issues with rail service. I'm sure George and others will be glad to hear that. We have a few isolated incidents I think anybody could find, but overall we're doing very well. I will say, as Brad mentioned, we have a huge export program going on soybeans right now. And the railroads have done a very good job of pulling in back resources, locomotives, and pulling in furloughed crews to support that. And so up to this point in time, and we're early in the campaign, things are running pretty well. So we appreciate that. And as Bob said, lease cars are available and pricing is a little bit soft. We still have some DOT 111s to replace in the ethanol fleet. I think he said about 28% of the fleet, of the 35,000 car fleet, still needs to be upgraded to meet HM 251 requirements. by May of 2023. That's all I have. Anybody got any questions? I'm sure Brad or Jeff can answer.
Hey, Mark, this is Brian. What on the refinery exemptions, what exactly is that, and what kind of impact does that have from the industry perspective?
They were exemptions that were granted to, as I would call it, smaller refineries. I don't know if that's the actual case, how you describe them, to waive them from either blending or satisfying their requirements through RINs. Brad may be able to add a little more to that. They were made, some of them were made under the Trump administration, or maybe all of them were. I'm not certain on that.
Yeah, Mark, nothing really further to add. It's just I think it was a favor done, quite a political favor done to these refineries, that they didn't have to blend in ethanol. So the RFS then swung to the bigger refineries to make up that differential, or to step in and buy RINs, which is basically similar to a blending ethanol. You can just buy your way into your obligation. So it's anybody's guess right now as to whether this helps ethanol by increasing the demand or will improve the price of RINs, as these smaller refineries just say, we'd rather buy RINs. It's a bit more economic for us to buy RINs to take care of our obligation.
The estimate was over 1 billion gallons of potential blend demand here if they were all to actually physically blend the gallons of their gas production. But probably most of it gets satisfied with RINs purchases, would be my guess.
Okay, thank you.
Not surprising, Brian. This is pretty political, as senators in Iowa, Joni Ernst, who's up for re-election right now, was taking some heat, and so Trump ended up backing off on these exemptions to, I think, theoretically increase the demand for ethanol.
Got it. Understand.
Mark or Brad, this is Ann. I have a question, if you don't mind. I appreciate that you made a comment that, or you've let us know that at this point you have no major issues with rail service, which of course is something that the board is always mindful and paying a lot of attention to. Could you comment just at where we are with respect to the harvest? It seems like it's in certain commodities it started a little earlier than usual. Are things on track? Are they, are things sort of contrasting to where we were at the Grain Car Council meeting about roughly a month ago? Everything is sort of on point, or is it because the harvest is a bit maybe more expedited in terms of timing do you have any, does your crystal ball show any particular concerns with respect to service go forward?
I can take that one, Mark.
Yeah.
I thought you might.
So
Thank you.
as of October, I'm just looking at USDA and publishes crop progress.
Right.
Of all the states that are harvesting right now on corn, we are 25% harvested. 5-year average would be at 24, so that's very much on pace. However, what's going on is the farmers are going after soybeans in a big way right now. And bear with me as I pull this up. We're at 38% harvested, or almost 40% probably, as of this would have been Sunday, and versus an average of 28%. So yeah, farmers, particularly in the Western United States, are really getting after beans And given the forecast being fairly dry here, it's very possible some of these areas may be finishing up on soybeans by the end of this week, or certainly by early next week. So the pace is moving very quickly. To answer your question, the railroads, particularly the Western railroads, a little bit of hiccup with the BNSF out on the PNW a week ago. They seemingly have gotten that straightened out here as of late. Things are moving or flowing. George might be able to answer some questions on that, but from our perspective, things seem to have resolved from kind of a bit of a pile up on the Pacific Northwest. But seemingly things are running well. They're throwing enough crews and power at the harvest to keep up with us, and from right now, things from my perspective are moving okay.
Yeah, I'd echo that, Ann. It's an early start. Actually, harvest probably started. The big move started before harvest with a push on old crop stocks coming out, and so we've been running hard since the 1st of September. So a good 2 to 3 weeks prior to the actual start of harvest.
Thank you both.
Yep.
Any other questions for Mark or Brad? Okay, thank you guys. All right, next on the agenda is a utility update, and that's going to be Emily Regis. So Emily, I'll turn it over to you.
Thanks, Brian. Good morning, everyone. I'll be presenting the utility segment update today, and I represent the cooperatives on the RETAC committee. I'm the fuel services manager for Arizona Electric Power Cooperative. And I wanted to also mention that I worked with NCTA and the Freight Rail Customer Alliance and NRECA in pulling together the information that will be presented today. So I want to thank those groups for their support and help with putting this information together. Next slide, please. So we've in the past reported for this utility segment annual utility inventory survey, and we wanted to focus on something different this time. Not that inventory isn't important, it still is, but we've noted a lot of factors affecting coal consumption. Environmental and market factors have resulted in less coal consumption for a lot of utilities. The coal industry itself has been consolidating. We notice a lot of less equipment used, a lot of less coal cars in transit, a lot of cars in storage, and perhaps a lot of shipments becoming more seasonal for utilities, maybe concentrating in the peak seasons, more shipments. So this presents a lot of challenges for both the carriers and the shippers to maintain efficiencies, actually a lot of pressure to find efficiencies in operational and for equipment. So we hit upon the idea of collecting some data on shipper transit time and their service metrics, and from what they appear from their perspective. This could be useful for the industry as benchmark data as things change over time, maybe to help other shippers with their logistics and planning, look at how their shipment cycles are comparing with other similar shippers who are moving coal from the similar regions over similar mileages. And this would be a way to offer some educational metrics for the STB and this group, the RETAC group, and possibly the RSTAC group. And then as an ongoing dialogue regarding some of the issues in regards to PSR and various rulemakings. Next slide. So as I mentioned, the NCTA and the FRCA and the NRECA worked together on putting together this presentation. We were in a unique position to represent lots of utility members, maybe overlapping utility members between our organizations. We came up with the idea of soliciting on-time performance survey data from utility members. Utilities keep track of their Railcar or train transit time records, and it's useful in their forecasting process. So we, in mid-August, solicited the survey to the membership. And what we got back is a representation of 22 different power plants over 5 different coal supply regions. It includes shipments on Class 1 railroads, multi-line railroad movements, and short line movements. And we asked for the mine to plant transit time by railroad and coal mine source with one-way mileages as part of the data that we collected. And it was a full year's worth of set of data between August 2019 and July 2020 for each of these plants, a round trip transit time. And we also asked some questions about how they're conducting their forecast. Is it done in-house? Are they using a railroad forecast? And I'd like to mention too, this was all voluntary participation, and all utility members that participated, identities will be confidential. All the data is collected at the end of this slide deck. We probably won't have time to go through each and every one, but each utility or each plant that reported data is represented in a set of index slides at the end of this set. So next slide. So it might be helpful to talk a little bit about how do shippers forecast their transit time. If they're planning for train sets moving to coal mines, which is a round trip, kind of a constant thing for a train set, maybe dedicated train sets between mines and plant sources, how are they planning for that? And there's many different factors that are used in developing the transit time forecast. As you can imagine, you're taking into account how much coal you're going to be needing, your size of your inventory. You're working with an energy load forecast. There's various considerations regards to seasons, your perhaps operational seasonal considerations, how many train sets you have in service, what type of cars you're using. Then there's also railcar maintenance planning and plant outages that figure into your forecast. There's a time that you have to account for when those train sets might be parked, when maintenance might be done, when you're going to be shopping those trains, when you might actually have outages at your plant. And then the various dumping operations at the utility, staging and placement of trains, that figures into the forecast as far as how efficiently you can move a train set in and out of the utility and to the mine and back. And then there's something that we call free time for unloading and unloading trains. A certain set of hours at the mine when the train is being loaded and when it's being unloaded, that would figure into your forecast as well. And then of course the geographic location of the plant and how many miles it's located from the mine source and where those mine sources are located. And if you're moving the train over a single railroad or multi-railroads, 2 or 3 railroads sometimes. So this all figures into the round trip transit time forecasts that you're using for planning purposes. And we asked the question too, if this is being done in-house, are you planning based on your own data, or are you being given a forecast from the railroad for your planning purposes? And then how often is that forecast being adjusted and why? Next slide. So this slide talks a little bit about the various forecast methods that a shipper might use. It's often, when I try to explain it to people outside of the industry, it kind of works like an algebra equation. When you move coal, you're receiving a mine source manifest, and there's going to be a date timestamp included in that manifest that shows the arrival of that empty train and the release of the loaded train. And when that train arrives at the plant, there's a record of when it arrives and when it's released, another date time stamp. So that's actually a pretty simple equation. You can take those hours that the train is in transit and calculate the days in transit. And that's the round trip per shipment. And that's how we're representing in our data, is the days in transit for each plant. So we asked the shippers if they would respond to a question about are they including the unloading and loading free time hours in their forecast planning. 10% of the shippers that responded included it, 90% excluded it. Also, 85% of the shippers that responded were conducting their own forecast process in-house. 15% reported that they were working off of a railroad forecast that they were given. We also asked the shippers how often they're adjusting that forecast in their process. 9% adjusted annually, over half were adjusting it every month, a small percentage, 4%, adjusted weekly, and about 35% keep it the same on a running basis. Next slide. So this chart is just a representation of the various railroads that the shippers that responded are using. And it's really, again, this was just a voluntary survey. It's just a cross section of shippers. Obviously, it's heavy on the BNSF served plants, 55% in the orange group. And we also got a representation of CSX served, UP served, Norfolk Southern served, a few short line served plants, and then a few that reported they're using multi-railroads for their shipment cycles. Next slide. And this pie chart represents the various mine sources that were reported by those shippers. Pretty heavy on the Southern PRB, shipment cycle 65%. A few from the Rockies, a few from the Northern Appalachian sources, Northern PRB, and Illinois Basin represented in the group that responded to the survey. Okay, next slide. So this slide is where we tried to pull in all of the data that we collected. Of the 22 shippers that responded, this is how they responded. And what we were asking is what their annual average transit time per carrier looks like. Was it above or below the forecasts that they were using? So you can see each grouping by railroad. There's railroad labels listed for each group: UP, the multi-railroad group, the BNSF, the CSX, one short line, and I believe a small grouping from Norfolk Southern. So above the black line, those cycles are represented as the average annual transit time that was above their forecast. Below that black line represents the annual average transit time that they received actual below their forecast. So next slide, please. So we also asked shippers to volunteer some observations and concerns. I've just listed a few here. The first quote was that the performance time is improved for 2020 on the year-to-date cycle time, mostly equal to the forecast average. Another comment was, we never know when the railroad crew will show up to pick up the empty train. Can be 2 to 4 hours after empty train release. I just want to clarify that one a little bit. Empty train release is something that if you're releasing a train that's unloading at the power plant, it's the utility's responsibility to report when that train is going to be empty so that the railroad knows when to come and pick it up. So this can be done about halfway through the process of dumping a train. And that would either be done by a phone call or it's done online through the online system. It's like, hey, railroad, this train will be empty at such and such hour. Please send a crew. This comment is just showing that they sometimes see a delay in picking up their empty train. And then the third comment, projected ETAs are continuously slipping. And the last one is a concern that they are seeing a lot of train bunching issues and combination trains with 300 cars arriving at once. Train bunching, if you're not familiar with that term, that can mean 2 or 3 trains showing up together. that presents issues, I believe, for both sides, the carrier and the shipper. But again, these are just a set of comments that were volunteered by the shippers that responded to the survey. And again, as I said, the index data at the end of these slides, and Kristen, if you want to just go down to one of those slides near the end, we can show every respondent is included in this set. There's about 10 of them. We don't want to go through every single one, but you can see the blue bar and the orange bar is representing, the blue bar is representing the actual average round trip days per month. And the orange was what they used as a forecast. And this would show a BNS served plant, and if you're looking at the top one, and the one-way miles between that plant and its mine source. So every one of these is shown here. But we don't need to go through all of them. But again, I want to thank the allied shipper groups for their assistance and support in putting this together and helping me. And I can take any questions at this time.
Any questions for Emily?
Well, it's Ann. I'll ask a question up to Emily. The chart that you had that showed some of the transit times that exceeded expectation, and then and at the same time showed some that did not meet the anticipated delivery. Sort of the ebb and flow, if you will. Is it sort of as much of a challenge when a carrier provides you service sooner than what your expectation is, just as when it's lagging? Can you comment on that a bit?
Well, of course, I can't speak for all shippers, but I am a shipper.
I know you are.
And I would say that consistency is always appreciated. I think it's probably appreciated on both sides. But it could present some issues, because if you're not expecting a faster cycle times, then you've got issues with, well, what do I do with my rail cars in between shipments? Or if I don't have enough shipments to keep that train moving, or you may be, inundating your inventory size that you may not be able to manage. And if that shipment cycle is going to vary greatly, it definitely could put both the mine source and the shipper in a little bit of a bind. I mean, it's always adjustable and you can manage things, but that, again, as I said before, consistency is always appreciated, I believe.
Thanks, Emily.
Thank you.
Emily, Mark Houston, quick question for you. On the grain side, we have pre-release notices on empty or on unloading trains. Do you do that on the coal side, where we have to give a certain 4-hour notice of when we're going to be ready for pickup?
Yes, utility shippers are supposed to give notice, as I said, maybe about halfway through their unloading process. So they estimate, hopefully within, an hour to half an hour of that time when that train is going to be released. So that's either done by a phone call, it's done online. Again, this is usually a pretty consistent process. So if you're given 5 to 7 hours to dump a train, you've got a pretty good idea halfway through when you think it's going to be empty.
Also, you mentioned bunching in there. I think it said 300 cars or so. Is that where two trains are put together, or they just happen to run together?
Well, it wasn't clear from that particular comment, but I have heard some utilities reporting, they've seen some of their trains doubled up, even on the loaded side, or mixed cars with maybe other sets, I guess. So I couldn't speak to that one specifically, but with bunching and with that size of a train, that could present a problem for a utility.
Thank you.
Emily, this is Brad Hildebrand. We had quite a Well, I'll call it a spirited conversation regarding trip plan compliance a year ago in Paducah. And just curious, and so trip plan compliance meaning when you build cars or a train, how close to the time that the railroad says that they should arrive at a given destination do they actually arrive at that destination? And I don't know if you had any conversation or part of your survey that registered that or got opinions on that. Clearly, it's something I think we have an interest in within the grain industry to measure that and have the STB report that out as part of their overall service metrics. I think that the question is, what is a standard for all class ones to hit as far as plus or minus X number of hours, which gets at your comment about consistency, and then to be able to measure it appropriately and then track it over time as a shipper, certainly within the grain industry. Consistency, as you point out, is important, but also being able to measure it consistent across the different railroads so we can compare performance, I think is also helpful. Do you care to comment on that?
Well, yes, we looked at that, and it's kind of a technical issue and kind of complicated for coal because it's not really the same for everyone. And we tried to pull together enough data to be useful, I guess, as far as utilities that are shipping similar mileages on similar railroads from similar sources. How would we be able to collect that and show that? Trip plan compliance, that's kind of an issue that's, some of the utilities that may not have wanted to respond to the survey can't show that or can't talk about that. And some of them don't really have any requirements. But again, as far as forecasting and transit time, that's important to both parties. You want to know, how many trips can you fit into a month or a year, and that helps you plan how many train sets you need to rely upon and everything else, down the line. So we thought we were in a unique position to be able to collect all this information because of all our overlapping shipper utility members. But we'd be happy to talk with anybody else about what other useful metrics we can pull out of this type of survey process. We hope to continue doing it, and hopefully it's useful to someone. So thanks for those comments. I hope I answered your question.
Thanks.
Any other questions for Emily?
I will just note, this is Kristen, I will just note that all of the slides are on the RETAC page on the STB website.
Okay, good. All right. Well, thank you, Emily.
Thank you.
I guess I am up next. I'm actually pinch hitting and doing the mining update. So, Kristen, if you want to go ahead and put those slides up. All right, you can go ahead to the next slide. I'm going to do a quick mining update and just kind of give it to you from a utility perspective, kind of where we see the state of the mining industry right now. First of all, there are hundreds of mines still in operation. Now, still in operation can mean a lot of things. During this past year, I will tell you that a lot of mines have idled, have shut down briefly for COVID-related or demand-related reasons, et cetera. But you still have hundreds of mines throughout the country that are still in operation. However, financial health is still an ongoing concern. There's a lot of utility mines that have either have shut down or they're kind of operating at a minimal level, if you will. And some of those, quite frankly, are just prolonging their life due to high back-end cost. And what that would mean would be the reclamation cost on the back end. They're trying to put that off and avoid that as long as possible. And so they're going to continue to mine the minimum amount, if you will, to continue that process. From a production standpoint, I got this data from Energy Ventures Analysis, EVA. Seth Swartz, who has actually spoken at RETAC before, they put out reports periodically, and I got a lot of my information from that source. From a production standpoint, we're on track for the worst year since the 1960s, which is pretty depressing. Q2 in particular was really bad. You had three really primary drivers. Weather was not favorable from a coal demand perspective. Natural gas prices were extremely low, much lower than predicted. A lot of the Henry Hub prices had a one handle on them. And then, of course, you had the COVID impact, which began towards the end of Q1 and really manifested itself throughout Q2 with a lot of businesses and industries and commercial businesses and things of that nature that either were shut down, were idle, people stayed home, etc. So Q2 was sort of a bottoming out period, kind of an imperfect storm, if you will. If you look at actual production from a mining perspective, year-to-date 2020 from January through June is 30% below where we were in 2019. You think about from a production standpoint, in the heyday of coal production in the country, we were somewhere between 1 billion and 1.2 billion tons of coal produced. Back about between 10 and 15 years ago. We're on track this year for probably something in the 600 to 700 million ton range. So quite a dramatic drop from an overall production standpoint. Just a couple of stats here that might be of interest. About top 50 coal companies produce about 90% of the U.S. tons. And of that, about the top 10% of the coal companies produce around 65% of the U.S. tons. So what that says is there's still some pretty large players that produce the lion's share of the production, but there continues to be a lot of smaller players that are still in business as well. Next slide, Kristen. What I'm going to do here, I'm just going to go through some of the various regions and just kind of give you a flavor and perspective of kind of who's still in business and what's going on. Starting out west, and this is primarily the PRB region, but it does include some of the Rockies production. Year over year through Q2, change in production is around 29% down. Some of your big players out there, and basically I just chose anybody who had produced at least 1 million tons through the first half of the year. You've got Peabody, Arch, Intech, Kiewit, FM, Wolverine, Signal, and Murray. And so those are kind of some of your big players out west, and not sure if I see that really changing going forward, at least in the near term anyway. Next slide. Illinois Basin, which is going to be primarily in Illinois, Indiana, and to some degree in the Kentucky region. Year over year, down 37%. Some of your big players there are going to be Forsyth and Murray, Alliance, Peabody, Prairie State, Sunrise, White Stallion, Nighthawk. The Illinois Basin also does play some in the export market, which that has been down recently as well. And so pretty substantial change year over year in the IB. Next slide. In the CAP region, which has really been decimated over the last decade or so, and even this year over year, is down over 50%. And we're primarily talking about in the Virginias, Kentucky, Ohio regions. You still have some pretty big players there: Contura, Blackhawk. I'm sorry, I misspelled that. Arch, Coronado, United, and Ramaco. And so, those are areas that also would, could and can at times play in the export market, but the export market has been pretty dismal over the last probably 6 to 12 months or so. Next slide. Northern App, which is primarily going to be in the Pennsylvania, West Virginia, and to some extent the Ohio area. Same story. Year over year production is down almost 40%. Your big players up in that region are going to be Murray, Consol, Alliance, Contura, Arch, and Rosebud. And there's plenty of other smaller players in that region as well. This is yet another region that can and does benefit some from export. There's hope out there that in 2021, export is going to pick up. There's a lot of people who are keen on, from a production standpoint, that gas prices are projected to go up in the latter part of 2020 and into the first half of 2021. We will see if that comes to fruition or not. Lee looked earlier at some of the oil production and a lot of the associated gas that comes with that. Well, with the decline in production from the oil perspective, there is an expectation there's going to be a decline in production from a gas perspective as well. So there's a lot of expectation, a lot of forecasts that are showing gas prices in the high 2s, low 3s from a Henry Hub perspective. I've seen some that are projecting gas prices even in the $4 and $5 range in the first part of 2021. We will see if that comes to fruition or not. From a mining perspective, certainly that will be a sigh of relief, and will certainly increase demand if that were to come to fruition. But obviously there's a lot of things, not only gas prices, but the actual demand from the power sector as well. And of course, the ever-present weather and impacts and things of that nature. Cold winters can certainly drive up demand as well. And I think that's the last slide. Is that it, Kristen? All right, any questions? I know that was just kind of a quick overview, but just kind of a perspective of kind of what's going on and what we're seeing out in the mining industry. Any questions for me? Okay. I will turn it over to George. I believe he's going to do the update on railroads. So George.
Thanks, Brian, and good morning, everyone. This is our railroad industry report, and I'm going to read our prepared remarks for you. So first, 2020 started out much like 2019 ended. Trade disputes continued to impact intermodal volumes. Manufacturing output was flat and consumer spending was moderately higher. Overall economic growth was slow but positive. Overall rail traffic was down, but not excessively. In early March, Saudi Arabia and Russia entered into an oil price war that sent U.S. oil prices plummeting downward by roughly 30%. A few weeks later, the pandemic came, when much of the economy shut down beginning in the second half of March. U.S. GDP, consumer spending, and industrial output all plunged. U.S. rail volumes followed suit. Total U.S. rail carloads fell 25% in the second quarter of 2020 from the same quarter in 2019, the biggest quarterly decline on record. Intermodal volume fell 13%. Because of the pandemic, carload volumes fell across most commodity categories. For example, year-over-year carloads of chemicals fell 13% in the second quarter, in part because of the big decline in ethanol volumes. Carloads of petroleum products fell 25%, carloads of lumber and wood fell 13%, and carloads of motor vehicles and parts fell 65% as the North American auto industry essentially shut down for a number of weeks. Railroads established three main goals in their response to COVID-19. The first is employee safety. Railroads and their chief medical officers have been working together to update and adapt their plans to specifically address the need to contain, mitigate, and respond to the COVID outbreak and protect our employees. My understanding is that because of these efforts, the number of confirmed COVID cases among rail employees has been relatively low. I'm not aware of any circumstances in which Class I railroads have suffered meaningful business interruptions due to pandemic-related crew shortages. Railroads have been able to continue to deliver the service our customers and our country depends on, and at the onset of the pandemic and continuing all the way through today as our economy begins to recover. Railroad's second main goal is to continue to provide safe, reliable service. Virtually every railroad customer has adjusted its operations because of the pandemic, and railroads have partnered with them all the way. This collaboration has been critical in the success, given that the recovery has varied by sector, with some, for example, energy, still well below pre-COVID levels, and others, e-commerce, now exceeding pre-COVID levels. Railroad's third main goal is to preserve their financial stability. One way that we have done this is by continuing to improve our operating practices, resulting in more resilient rail networks that are better able to adapt to marketplace changes. Thanks to these changes in close coordination with our customers, America's freight railroads are, by and large, running extremely smoothly despite the pandemic. Railroads will continue to work very hard to keep it this way. Thankfully, rail volumes have been heading higher in recent months as the economy has slowly reopened. On the intermodal side, volumes are actually now above where they were before the pandemic, thanks to surging activity at ports and robust customer spending on goods. On the carload side, rail shipments of motor vehicles are back to pre-pandemic levels, while carload levels for most other commodities are well above where they were in April and May. Most, though, are still well below where they were before the pandemic. Coal has continued to lose share in the electricity market. Coal accounted for 18% of total U.S. electricity generation in the first 7 months of 2020, down 23% from 19 and 27% from 18. U.S. coal exports, much of which move by rail, are down significantly this year as well. As a consequence, U.S. rail coal volumes were down 27% in the first 8 months of 20 compared with the same period last year. The pandemic has led to a global oil and gas glut, causing reduced transportation demand for a variety of oil-related products, including steel for pipes, frac sand, crude oil, and certain industrial chemicals. Originations of crude oil on U.S. Class I railroads peaked in the third quarter of 2014 at 132,000 loads. In the second quarter of 2020, they were down to 30,000 loads, a 77% decline from peak. Carloads of industrial sand, which is mainly frac sand, peaked in the second quarter of 18 at 188,000 loads. In the second quarter of 20, they had fallen to just 33,000 loads, an 82% decline from their peak. Because of lower demand as drilling has fallen off and because of the substitution of locally sourced sand in place of sand that has been shipped by rail. The course of rail traffic volumes for the rest of 2020 will depend on how quickly the economy recovers, which in turn will depend on how quickly the coronavirus is brought fully under control. Recent business surveys offer some encouragement. For example, in September, the National Association of Manufacturers released its third quarter business outlook survey. 2/3 of the respondents reported having a positive outlook for their own company. That's up from only 1/3 in the second quarter survey. As reported at the last RETAC meeting, the railroads and their employees initiated a new round of national collective bargaining under the Railway Labor Act by exchanging Section 6 notices in November of 2019. This triggers a lengthy process that may include direct negotiations, mediation, arbitration, several cooling off periods, and in some cases, presidential appointment of an emergency board to recommend settlement terms. This process works. There have been no service disruptions arising from rail bargaining since 1992. National negotiations pursuant to the Section 6 notices formally began in early 2020. After a brief pandemic-related interruption, the carriers and unions involved in the national negotiations have resumed a regular meeting schedule and are engaged in direct negotiations. Like firms in every other industry, railroads must manage their resources, including locomotives, freight cars, and employees, based on business needs. Railroads will continue to work hard to ensure that they have the resources in place to safely and reliably meet the transportation needs of our customers. From time to time, though, demand for rail services exceeds expectations. When this happens, railroads do the best they can to meet the needs of their customers as quickly and efficiently as possible. This goal is made much more difficult to achieve when extraordinary events occur. The nature of railroading is such that major derailments, bad weather, serious maintenance issues, and many other events can and do inhibit the ability of railroads to function effectively for days, weeks, or in worst cases, even months. In addition, railroads rely to a large extent on the accuracy of the forecast of future demand from our customers. Because of the need to bring workers and rolling stock where they are required and the need to manage the network impacts of additional demand, rail service cannot be turned on like a spigot. In addition, railroads must be confident that traffic and revenue levels will remain sufficiently high over a long enough period to justify the cost of the additional resources. In this regard, railroads are no different than the vast majority of our customers. This concludes my comments on behalf of the rail industry. I now invite any of my colleagues from the other railroads to offer any other comments and to take any questions.
This is Ken Avery. Could I make a comment? Can you hear me?
Sure, Ken.
Yeah, look, you had mentioned that as the downturn has come about, that the railroads have partnered with customers, I think you said all the way, but I got to tell you, that's not my experience, George. Quite the contrary. I mean, we're seeing service being cut by days of week or hours in the day that don't really jive with our operation. And it's not a collaborative effort, it's dictated to the customer. And so there's plenty of examples like this. I would encourage a collaborative effort, but the way the industry is set up, it's the railroad tells the customer what's going to happen. And that needs to change, George. That's my only comment.
Thanks, Kent, very much. We work hard at making sure that we are listening, and then we need to make sure that we work with you guys to put together the best low-cost, safe service option. And Kent, we'll certainly follow up with you on some specifics with that. Other thoughts, questions, concerns, other notes? I will say that attached, and Kristen was just flowing through this, we do have the metric deck, and we'll leave that for reference for everybody to review. And we can move on to the next segment, which is, yeah, she's flipping through it right there. That shows a lot of the stats that the other industry segments had mentioned, but it's our standard deck that we have in place. So
George, this is Lee Johnson. Can I ask or make a comment?
Sure, please, Lee.
Yeah, I just wanted to reinforce, I think, the correlation between what I was saying about Dakota Access Pipeline and your comments about what it takes to meet surges in demand. And in the event that Dakota Access were to be shut down and there was a surge in demand for crude by rail and markets adjusted, I think everyone just needs to understand that it's not flipping a switch. I think the railroads and the oil companies have done a very good job of reacting when demand craters, and we allocate assets and shut things down pretty quickly. The return doesn't happen that quickly. And, you know, as Bob mentioned, there's a surplus of tank cars available, but many of the loading facilities are idled. Many of the receiving facilities are idled or have been repurposed. Crews have been sent elsewhere. Locomotives have been sent elsewhere. If there is a sudden surge, an unnatural surge in demand, such as would come from a unfavorable court ruling on Dakota Access, that would be quite disruptive, I think, for both the oil and rail industries.
That's a really good point, Lee. And both what you and Kent just said about the oil business that we share with each other, we want to make sure that, one, we're listening to, we're aware of the situation as it unfolds, and then we need to put plans in together. And to your point, Kent, we need to put plans in together to make sure that we're all meeting the demand that's out there. And back to your point, Lee, it doesn't get turned on overnight. We've got to work together. And I do want to comment too a little bit on Emily's presentation from a coal perspective. Emily, thank you for that. And she did a very good job of pointing out the complexity, not only of the coal pipeline, but also of all of the different pipelines, whether it be coal, oil, gas, the biofuels, ethanol, the origination and the destinations, like in the coal business, the mining companies, the railways, and the utilities have to put together operating plans that keep the flow of goods smooth from point A to point B. And so all of the external factors, we all work very hard on consistency and rateability. And when we do that, we can put together the lowest cost product, and that's what we're looking for. I will go back to you, Brad. I did get a quick report, and we have been working with you, as you know. Some of the issues we were having in the Pacific Northwest were some track work on the Lakeside sub. Also, we had some mechanical issues in the Flathead Tunnel that we've worked out, and we are working with you guys, as you know, on getting your goods to the right elevators. So any other thoughts, comments, concerns?
George, thanks for the follow-up on that. As we look out ahead, and Lord knows in today's COVID world and everything else, you know, we just can't run fast enough towards getting a vaccination and hopefully moving beyond our current situation. But as you look out ahead, and I'm going to be an optimist here, that some semblance of normalcy will hopefully come back to this country by, you know, hopefully the middle of next year. As you guys look out ahead, I mean, currently you've got, or most of you have people on furlough and continue to have people on furlough. Some of those folks are not going to be coming back. And have you guys started making plans that as we begin to recover, and so I'm talking 6 to 10 months, you know, kind of timetables here, what the plan is to make sure that you've got enough people to run your railroad appropriately? Because, you know, at some point in time, people that are on furlough are not going to come back. They're just going to say, I got to get a job. And so it's going to be a strain, I think, at some point, at least I would guess. And have you guys started thinking about that?
The short answer is yes, and our planning processes have been in place and continue to be in place based on the volume forecast that we get from you guys, our customers, and in whatever commodity groups that we're working on. And so, as an example, in the short term, we're seeing an uptick in our consumer products groups, and that's based on all of the demand that is out there from people staying at home and ordering everything on Amazon. And so in the short term, we're picking up that demand. In the longer term, we're certainly aware, and I'll go to the other end of the spectrum, we have the decline in coal, and so we're adjusting for that as well. In between is everything else, and we'll continue to put together short-term and longer-term plans based on the demand forecast that you guys give us and the critical nature of the information that you give us, and then we'll resource accordingly. So we are working on that, and as I said in my prepared remarks, we haven't seen any service degradation across the board based on the need for resources as we've been coming out of the COVID-inspired pandemic drop in businesses. Okay. With that, thank you all very much for those. Those were very good. I appreciate everybody's input in putting those together and delivering those messages. As Kristen said at the outset, and as Brian said at the outset, thank you all for participating. This does represent a unique challenge for us when we do it virtually. So I do appreciate everybody's participation and feedback, and we're always open to that. I am going to move to the next point on the agenda, which, Kristen, if you can report on any written public comments.
Sure. There are no written public comments received at this time.
Very good. Thank you, ma'am. And then what we'd like to do next is move to the board and get an update from the STB, and then we'll do our best to manage any comments and or questions that you have of the board. And with that, I'll turn it over to you, Ann.
Thanks, George, and thank you as well, Brian. I'm going to be fairly brief. I really just want to echo George's appreciation to all of you. Really very great presentations, very informative. And I appreciate some of the dialogue, questions, and answers that we've had throughout. My colleagues actually are going to provide an overview of some of the board's more actions with respect to regulatory matters, and also very important, some of the COVID related endeavors that we've all been focused on over the past 6+ months. And I just want to sort of remind everyone that the board, we engage regularly with our stakeholders, as I think that you know, and part of that dialogue also can be facilitated through the board's Rail Customer and Public Assistance Office. I'd just like to put a plug in for them. Area code 202-245-0238. They are available. They can take confidential information, or if you actually are having a service issue that you want them to assist you on or to inform the board on, please make use of the resource. And as many of you have our direct emails and phone numbers, and I know that none of you are shy when you want to pick up the phone, and that's appreciated usually as well. So with that, I am very happy to, by the way, I also want to really thank Kristen, our DFO, and Matt and Steve, who have worked to make sure that we could successfully pull off our first virtual RETAC meeting. There was, this seemed to go off without a hitch, but I can tell you there was a lot of time and effort to make it appear that way. And I really appreciate the effort that you have gone to on our behalf. And with that, I am going to introduce the Vice Chairman of the STB, Martin Oberman, and ask him to provide an update to all of you on various matters. Marty?
Thank you, Ann. Much appreciated. First of all, I want to add my thanks to everybody for participating virtually. This seems to come off without a hitch, as Ann said, but I want to echo Ann's appreciation for our staff, led ably by Kristen, as she does every year, and now she's become a digital expert and made this seamless for all of us. So great job, Kristen, and your team. I do want to remind everybody, I assume you know, but if you don't, the STB has been working remotely since roughly the beginning of this pandemic in March. And I think it's fair to say that our productivity has not only not decreased, but probably increased. So we're there if you need us and when you need us, and we're there to do our jobs, and we seem to be having a tremendous amount of productivity. Let me just highlight a few things that we have done this year so far under the driving leadership of Ann, which was needed to make sure we get these things done because they're complicated. As many of you know and participated more than a year ago in our demurrage hearings, we've taken a number of actions in the demurrage area. We did the following things. We issued a rule clarifying the exclusion of demurrage from certain of the class exemptions. So even exempt commodities are not exempt for purposes of demurrage. We issued a very lengthy and detailed final policy statement, which outlines the principles the board is going to consider when we evaluate any demurrage charges and cases going forward, and made it clear, we think, to all stakeholders what we think the policies on demurrage should be. We also issued a final rule that now requires railroads to directly bill shippers where the warehousemen and the shippers have agreed to that kind of an arrangement, which we think is a step forward. And finally, we issued a supplemental notice of rulemaking, which is still pending, asking for comments on a proposed rule setting forth minimum information that will, going forward, would be required to be put on demurrage invoices by the Class 1 carriers to enable shippers to better evaluate demurrage charges and decide whether to contest them. Excuse me. The other major area, of course, that we focused on is our Rate Reform Task Force report from April of 2019. We've had a number of initiatives under that report. We have already issued a final rule establishing a new streamlined approach for proving market dominance in any rate reasonable case. No one's tried it yet, but it's out there. We issued a new rule increasing waybill sampling rates, which we hope will improve, and we believe will improve the precision of our analyses of these matters. Probably most significantly, we issued a proposal for a new methodology for rate reasonableness cases called Final Offer Rate Review, which, if implemented, the goal is to constrain the cost and the time and complexity of a rate case. And that rule, we expect, will receive its next action during the month of October. So stay tuned. And finally, we held a 2-day hearing last December when we were still live on revenue adequacy, which was very enlightening and informative, I think, certainly to the board and board members, and I hope to the industry at large. And that's still generating a great deal of activity and thought about how and whether to go forward in that area. So those are the main substantive areas that we have taken action on. Of course, the board is constantly hearing cases, abandonments, trail use cases, and many other disputes, and we've issued many decisions over the last 10 months of 2020, and I'm sure that pace will continue. So thank you all again, and I will hand this off to Patrick Fuchs. And I'm happy to take, I guess we'll take questions when we're done.
Thank you, and good to be with you all. I'd also like to thank Kristen, who did an excellent job facilitating, and many thanks to all our presenters for the highly informative meeting. I think the opportunity to benefit from your insights is tremendously valuable to the board. I'm going to provide a brief overview of the board's actions concerning COVID-19. I'd like to start by commending Anne for her leadership, both internally and externally on the issue. And I know Marty and I join her in making sure the board is proactive and informed, and I think meetings like this are extremely helpful in that regard. So first thing is that we've been hosting weekly, now bi-weekly calls with our Rail Shipper Transportation Advisory Council, which consists of railroads, FRA, and shippers from a wide variety of industries, from ag to chemicals to scrap steel to beverages. And this call really gives us a broad perspective on both production and service, and we continue to host it through the fall. I will note that the board has received many very positive reports from shippers on the performance of railroads as COVID has disrupted these industries, and I think all three of us at the board deeply appreciate the efforts of the thousands of men and women who have kept things moving. Second is when railroads were making adjustments in the initial months, we participated in daily and then weekly calls with hosted by the FRA and including some of the Class 1, each of the Class 1 railroad COOs and certain short-line railroads. And the focus of this particular call was to monitor case numbers, disruptions, and any regulatory issues. In April, the board released a statement underscoring the DHS critical infrastructure guidance and urging state and local authorities to recognize the importance of railroad operations and to support the ability of railroads and their supply chain partners to contribute to the national welfare. In May, Chairman Begeman sent a forward-looking letter to each Class 1 railroad CEO, and the purpose of this letter was to receive information on railroads' preparedness to meet anticipated future demand, as well as on its employee and equipment resources. And then again in August, we had received forecasts of the robust harvest, which I think was covered very well by Mark and Brad today. And we received some reports about service issues and potential emerging service issues. Again, I want to emphasize that we have really received some extraordinarily positive reports in the main, and the reports didn't about service issues didn't pertain to every area or every railroad, but consistent with that kind of proactive theme and underscoring the board's focus on rail service. All of us and as well as Administrator Vittori from the FRA, our partner in these oversight efforts, sent another letter to each of the Class 1 CEOs emphasizing employee availability, sufficient equipment resources, and communication and transparency, all of which we've heard about today. And on a going forward basis, we're going to continue our active monitoring of service and COVID issues, informal and formal calls. The AR state level and national reports have been very helpful, and continuing to look at the board's service metrics. So, as Ann kind of mentioned, we are keeping the lines of communication open, and we are here to help in any way that we can. So thank you all for being here and participating in this very helpful meeting.
All right, thank you guys very much. Any thoughts, comments, concerns from anybody? I do want to recognize Betty Whalen. Betty had some thoughts about rail service from Emily's presentation. Betty, are you still on?
I am, but I'm not sure I have my mic set up right. Can you hear me?
Yeah, it's working now.
Okay, great. The settings are different when you do Teams than Zoom, and so I was trying to talk and nobody was reacting. I was like, oh man, I don't have it set up right. The only thing that I wanted to comment on, and George, I want to tell you that we have bi-weekly meetings with your ops guys, and I think that's gone really well. So I think I can personally say for LCRA, we have a great working relationship, and things happen and on both sides. But I think we are doing a really good job of coordinating our efforts. But there was a comment that came up about, I think Ann asked whether or not there were concerns if trains were running faster or were arriving early versus late. And I think I can speak for us is that we have a third party who unloads our trains, and we own a lot of our own train sets. And so what's important to us is that the time that we're being told that the train's going to arrive is the time that it arrives, whether it's early or late, because these people have to drive, some of them, hour and a half maybe to get to the plant to do their duties. And so, consistency, whether it's, just in general, consistency is just important for smooth operations, because then if we get out of rhythm, then, it throws even the train crews, out of rhythm as well for calling crews out. So I just wanted to make that comment, but I also did want to acknowledge that, I think from just personally for our perspective, things are going relatively well.
Great, Betty. Thanks for
This is Ann, Betty. I just want to thank you for responding to my question. I much appreciate your comments.
You're welcome.
I as well. Thanks, Betty. And I'll make sure that my guys get that feedback and, keep us posted, and, for everybody, whether it be on the mining side or on the utility side from us, not only here at BNSF, but all of the railways. We need the feedback. We're dedicated to transport all of your goods in a timely manner, and that's something that we take our responsibility very seriously, particularly in these difficult times. Okay, that is it, unless, I'll be quiet for a little while. Any other?
Hey, George?
Yeah. Brad?
Yeah, it's Brad. So I've been an advocate for a while here of us going to one of our 2 meetings per year virtually, and I'm just curious how how people feel about that going forward. I certainly support that. I know it's not the same to not get together in person, but from an efficiency standpoint, a cost standpoint, I think what we're finding out in this COVID world that is we can do a lot of things, as Marty just mentioned, about how efficient we can be virtually versus in person. And I'm just curious if this is something the board would entertain taking one of our 2 meetings as we come out of this COVID world eventually to virtually versus in person.
Hey, Brad, it's Ann. I'll respond to that. And of course, my colleagues are welcome to as well. But I think this meeting really is proof that we should have listened to you earlier. No, I'm teasing you. I think you make a really good point, and really what the board wants to do, you know, we get great value out of everyone's participation, and the more that we can facilitate and ease that participation effort so that we can have as many of the members involved as possible, we really do want to do. And, you know, we value, you know, the group, the entire RETAC group's input on such a thing. And so I think Kristen will be given a new assignment just to reach out individually or maybe just get feedback from all of you just to make sure everyone agrees that this, you know, the once a year meeting virtually, or we could even do that more than once a year if one wanted to. So we are open to change and to promoting efficiency and dialogue and good ideas. So thank you.
Let me just jump in for a second and add on to what Ann said. I think the whole country and the economy are learning from these experiences about how we can do business going forward. And perhaps there will be a number of changes. Of course, I want to emphasize that I still, and I'm sure Ann and Patrick do too, value the actual in-person interaction when it's going to be feasible again. There's something missing virtually, even though we get a lot done. So I certainly wouldn't want to undermine our personal contacts. They're very important, at least to me, but I'm from a different generation.
This is Emily. I just wanted to mention that NCTA has just conducted 2 of its recent conferences in a hybrid format where both in-person and virtual attendees were able to participate. And we're learning a lot about that, and we may continue to offer it that way. And that may be something to consider, that you could do both. So it can be done. Just wanted to throw that out.
Great. Thanks, everybody. I think we all are learning how to do business in this new environment, and we are adapting, and we will persevere, and the railways will keep your freight moving. And as we've demonstrated year over year and event over event, and that's something that we want to make sure that we've got the most effective way to communicate with each other. Other thoughts, comments, concerns?
Hey,
okay,
George.
Yeah. Hey, Tony.
Yeah, Tony Recker. Just want to comment that I've been on several of these virtual meetings, and this one was put together as well as anything. It really, I appreciate everybody, all they did. It was an excellent presentations and just very informative, and just went off without a glitch. And that's unusual. Thank you.
You're welcome, and I'll take that. And from an administrative point of view, we've got the next meeting to look forward to. And instead of discussing it here virtually, what we will do is we will follow up with each of you in the weeks to come to pick out some dates in the spring, and we'll put together how that will work. In this dynamic world, a lot of things can happen between now and then, and we'll keep everybody posted. With that, I would also want to thank Kristen. You did a great job putting this together, and Mr. Fuller and I very much appreciate that, as well as everybody else. You personally made this thing happen, and our thanks and my thanks to you. Well done.
Ditto.
So with that, I think I will adjourn with a safety moment, as Brian started with the safety moment. And with everything that's going on, keep your distance, wear your mask, wash your hands. Everybody have a great day.
All right. Thank you. Nice job. Bye-bye.
Thank you.
Thanks, everybody.
Many thanks.
Thank you. Take care.
Thank you, everybody.
Well done.